Are gold and silver truly universal safeguards, or are they merely shiny distractions? This question often sparks intense debate among investors, economists, and financial advisors alike. Today, we cut through the noise to provide an objective, analytical perspective on the historical roles of precious metals in a diversified portfolio. Understanding their true utility is crucial for informed financial education and effective asset allocation. No single asset offers absolute protection against every conceivable risk. Effective portfolio diversification hinges on understanding specific risk exposures and selecting assets that historically mitigate those particular threats. Gold and silver are no exception. Their protective qualities are highly contextual. Their inclusion in a portfolio should stem from a clear understanding of which risks they address, and equally important, which they do not. This analytical approach moves beyond anecdotal evidence, focusing on historical performance and economic principles. Historically, gold and silver have served as a robust hedge against the erosion of purchasing power over extended periods. Unlike fiat currencies, which can be devalued through monetary expansion, precious metals possess intrinsic value. They have consistently preserved wealth across centuries, acting as a stable store of value when monetary systems undergo significant changes. This makes them a critical component for long-term wealth preservation. This characteristic is particularly relevant for investors concerned about inflation and the long-term stability of government-issued currencies. Their finite supply and universal acceptance contribute to their enduring appeal as a hedge against inflationary pressures. During periods of profound monetary instability, such as currency crises or widespread loss of confidence in financial institutions, gold and silver often shine. They operate outside the traditional credit system, making them less susceptible to banking failures or sovereign debt defaults. This non-correlated behavior provides a crucial layer of portfolio diversification. When central banks implement unconventional monetary policies or geopolitical tensions escalate, precious metals can act as a safe haven. They offer a tangible asset that retains recognition and value, providing continuity amidst systemic uncertainty. Throughout history, monetary systems have evolved, with currencies being debased, replaced, or entirely reimagined. Gold and silver have consistently bridged these transitions, maintaining their status as recognized forms of wealth. Their historical role as hard money provides a stable benchmark. This enduring relevance across different economic regimes underscores their utility as a long-term asset. For economists and students of monetary history, this resilience highlights their unique position in the global financial architecture. It is a common misconception that gold and silver offer protection against short-term market fluctuations. In reality, precious metals can exhibit significant price volatility over days, weeks, or even months. Their prices are influenced by a complex interplay of supply and demand, speculative trading, and macroeconomic sentiment. Expecting daily or monthly stability from gold and silver misunderstands their primary historical function. They are not designed to be short-term trading instruments for capital preservation against minor market corrections. While often perceived as safe havens, gold and silver do not consistently protect against the broader impacts of economic recessions or downturns. Their performance during economic contractions can vary widely. Prices may rise, fall, or remain relatively flat. They do not prevent job losses, business failures, or declines in overall economic activity. Their role is more nuanced. They may hedge against monetary aspects of a crisis, but not necessarily the real economic impacts. Investors should not view them as a panacea for all economic woes. Crucially, gold and silver are not substitutes for sound personal financial planning, emergency funds, or a stable income. They do not generate cash flow, dividends, or interest. Relying solely on precious metals to navigate personal financial hardship is a precarious strategy. They are a component of a diversified portfolio, not a replacement for essential financial security measures. For the general public, understanding this distinction is vital to avoid misallocating resources. Many misunderstandings stem from applying short-term expectations to assets designed for long-term strategic roles. Behavioral biases, coupled with sensationalized media narratives, often lead to unrealistic expectations. Gold and silver are frequently judged by metrics they were never intended to address. A robust financial education emphasizes the importance of aligning investment horizons with asset characteristics. Their role is structural within a portfolio, providing a long-term hedge rather than a tactical tool for quick gains or immediate crisis avoidance. Precious metals are not infallible guarantees, nor are they universal solutions to every financial challenge. They are historical tools that have served specific purposes under particular economic and monetary conditions. Their value lies in their ability to perform a distinct role within a well-diversified portfolio. For investors and financial advisors, this objective perspective is paramount. It allows for their strategic inclusion based on analytical reasoning rather than emotional responses or market hype. During periods of high inflation, gold and silver often gain prominence in discussions due to their historical reflection of monetary value changes. While they can act as an inflation hedge, this relationship is complex and not always immediate or perfectly correlated. Their performance against inflation is often more pronounced over longer time frames. It reflects a relationship rooted in monetary principles, not an absolute promise of short-term immunity. Real assets like precious metals can help preserve purchasing power, but their efficacy depends on the specific inflationary environment and other market factors. Clarity regarding the strengths and limitations of gold and silver is fundamental for informed decision-making and effective risk management. Understanding what they do and do not protect against prevents disappointment and fosters a more rational approach to asset allocation. This analytical rigor is essential for all audiences, from students learning about finance to seasoned economists. History provides the empirical evidence needed to evaluate precious metals calmly, without exaggeration or unwarranted dismissal. It empowers investors to construct resilient portfolios. In summary, gold and silver have historically provided protection against the long-term loss of purchasing power and monetary instability. They serve as a hedge against systemic risk and currency debasement, offering a non-correlated asset in times of uncertainty. However, they do not consistently protect against short-term price volatility, broad economic recessions, or individual financial hardship. Understanding both sides of this equation allows for a realistic and responsible approach to incorporating precious metals into a diversified investment strategy. Their role is strategic, contributing to overall portfolio resilience rather than offering a singular solution. In our next discussion, we will delve into how central banks view gold today, exploring its continued relevance in modern financial systems and its implications for global economic stability. Asterisk. Disclaimer: this content is for educational purposes only and is not financial or investment advice. Always consult with a qualified financial professional before making investment decisions. Soft call to action. Please like this video if you have found this objective analysis helpful. Every like we receive inspires us to create more informative and educational content for you. Thank you once again for watching. We hope you have a blessed day.